Hey, I guess the music's done. Yeah, what's going on? How you doing? Hey, it's Friday. Welcome to Forex.Today, the YouTube community of almost 20,000 foreign exchange traders. Huh? 20,000. That's pretty amazing. This is a small community of Forex traders. There's not a lot of us. You guys know Joseph Trezevani? I think he works at FX Street right now. Uh, he was telling me his story, and he used to work for a bank and then a fund and all that kind of stuff. And they sent him out to Bermuda because that's where it was tax. It was for tax reasons and stuff. It was a great place to trade Forex back then. And he was trading for this fund, and he got to the island, and there was like three other Forex people. Like there was literally like four, maybe five Forex traders on the whole island, and that was it. And they would all hang out, and they all worked for different people and stuff like that. So wherever you go, the Forex traders, it's a small community. It's really cool. And if you work for a bank as a Forex trader, all the investment bankers are jealous of you. Why are they jealous? Well, investment bankers, right? Bankers work 24 hours a day, 7 days a week. They work 20 hours a day on the weekends. Forex traders go home to their wives and their girlfriends and their spouses or whatever and, live a fairly normal life. Yeah, it's 24/7, but there is a weekend and all that kind of stuff. So it's kind of interesting. And there's a lot more iBankers than there are Forex guys. So anyways, it's great that we have this community and we can get together every single day, go through our charts, talk about what's going on, and of course, just be together, right? I love hanging with other Forex traders. So thank you for being here today, and thank you for being a subscriber of Forex.Today. With that being said, Forex is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Sup? Hey, good to see you. So what's going on in the world? Well, we got a lot going on fundamentally, even politically and geopolitically. A lot of wheeling and dealing going on in the world. So maybe we'll talk about that. For example, the United States and Europe have decided to start planning out a deal for the United States to provide 10%, almost 10%, of Europe's energy needs. Who cares? Well, they're not going to get nat gas from the United States for free. So for those have taken the macroeconomics class, you can say, well, Europe had its possibility frontiers curve, production possibility frontiers curve, and now they've shifted the curve through the balance of trade, or terms of trade, balance of trade, terms of trade. And so that's kind of interesting, and now that is going to require now foreign trade, foreign currency exchange. That's cool. So that could be very interesting. It's not going to be interesting for today, but as far as long-term flows of capital, and that's what we care about, capital flowing across borders, then that's what the FX do. So anyways, we can talk about all that kind of stuff. We'll obviously go through our charts. There are some interesting things going on. Pretty exciting time. So let me go to the next part. You are here because you need something. Please ask. Okay? I am a servant. When I am here, I serve you. I aim to educate and share my experience and provide advice, be a mentor, be a guide, that kind of stuff. So let me know how it can help is what I'm saying. Beyond the daily webinars, in the description below the video, there's a link to my book. There's a link to free training courses. There's a link to paid training courses, which are $88 a year. So I'm not going to hit you over the head with a $1,000 course. There's a link to my chart templates, $5, bro. Okay. And then a link to tradersway.com. They provide fast execution speed, narrow spreads, big swaps, but they're a trustworthy, ethical company. And their business model has provided safety for their clients for many years. I like to give the example of the day the Swiss National Bank broke their peg and major brokers went out of business. And I don't know. I'm not I'm not a financial auditor. I don't know what these other brokers were doing, but they went out of business. And my first thought is, if they went out of business because they were holding bad positions, why were they holding positions? They're supposed to be brokering deals. They're supposed to be executing the trades into the interbanking system. So if these big brokers went out of business overnight, was it because they were trading against their clients? So anyways, back then, I just got to know Traders Way. And so I contacted some of the leadership. And I'm like, hey, man, are you guys okay? Brokers are going out of business. It's crazy. And they're like, no, we're totally fine. I'm like, well, really? And they're like, yeah, well, we executed all the trades. So we're fine. As a broker, we did what we were paid to do. I'm like, whoa, awesome. Whoa. Very interesting. So anyways, tradersway.com. Tradersway.com. All right, here he is. Dollar seems to be weak in the moment. Very nice. Pound has given back. Kiwi's given back. Swissy's given back. Yen is getting strong. Interesting, especially for those who were in the swing trading meeting last night. Very interesting. That's kind of what we were talking about. Could be interesting. Raymond says, I believe FXCM had to get a $500 million bailout from the ECB. Not the ECB, no. They borrowed $500 million, I think, from a hedge fund or some sort of funding company at a very high price, and then to be able to pay for that, they sold their U.S. business, including Daily FX, right? So they sold the U.S. brokerage, and they sold off their educational portal, and then stayed offshore. So wow. So Drew Niv walked in one day, like he went to bed that night, and he was the leader of the largest Forex broker in the world, retail Forex broker in the world, and he woke up bankrupt. Bet you that was a crappy day. Okay. Anywho, sucks, man. Sucks. All right. Let's do commodities. You guys are traded the oil? You traded oil? Okay, cool. So one of the things, like literally, I don't like to pip and tell, but let's talk about this. Last night we were in the swing trading group. We're like, hey, if oil comes down, yen is going to get strong. Oil's coming down hard, and out for the first time in 2.5, 3 weeks, yen is strong. Oh my God. So we were meeting sort of in this period here last night. And so Europe or Asia kind of took it up, and boom, Europe took it down. Meanwhile, the yens have done something same. Whoa. So for all those other side plans, wink, wink, nudge, nudge, maybe it's game on, huh? Okay, so we were talking about this strategic task force that Europe and the United States are putting together. I think the actual number is 9%. So of the energy, of the nat gas that comes from Russia to Europe, if the United States is able to do what they say they can do and provide that to Europe, that would cover 9% of the energy that comes from Russia to Europe. 9%. But I look at that and, I'm walking the dog and I'm thinking, I don't know what number 9% adds up to as far as euro, because, I think they were talking about how much liquefied nat gas. I mean, I'm thinking, well, I don't care about how much. I want to know the value of that, how much. And I'm wondering in terms of euro, okay? Interesting, right? Europe, well, let's put it this way. Oil, liquefied nat gas would go from the United States to Europe, and Europe would convert their euros into dollars and send those dollars to the United States. How does that play? Okay, so I think so, I've heard all kinds of weird numbers from the media, so I haven't done any research, but I keep hearing that Putin makes $1 billion a day on his liquid natural gas. So let's just say Europe will need to send $100 million a day to the United States. Jim says, weaken the dollar. Well, let's talk about it. If LNG is going to Europe, then Europeans are importing US dollars as well, because Europe has to send euros into the interbanking system, sell the euro, buy dollar, and then send the dollars to the liquid natural gas providers. Which means somebody in Louisiana is going to buy a nice big house. So that would be dollar strength, actually. Sort of like oil prices went up and euro CAD went down. Okay. Yeah. So there is an inverse relationship. If the United States is sending liquid natural gas to a foreigner, then they're doing it because they want to get paid dollars, right? That's it. So there's the foreign exchange. I'll give you my liquid natural gas. You give me some money, honey. Put some sugar on it. Yeah. So we export liquid natural gas and import US dollars. And that's what this whole X minus M is. Okay? How much do foreigners buy from us? And how much, right, do we buy from foreigners? Okay, that's the buy side. Right? But this is how much do we sell, and this is how much do we buy. So if we're selling, okay, then dollars are coming in. If we're buying, dollars are going out. So you can memorize it any way you want. But that's all part of, but it's productive, right? The reason we do this, though, is when you add up all the business transactions in the United States, you're usually trying to figure out productivity, right? GDP. So if we exported something, we made it here. So we want to count it. We don't want to count business transactions of us buying foreign goods and importing it into our country. That's not our stuff. See, the stuff we import is somebody else's productivity, and we don't want to count those receipts. So anyways, one of the things we import, or sorry, one of the things we export now is West Texas Intermediate crude. Okay? So oil prices, I wouldn't say coming down, but normalizing. We were approaching 120 again, and now we're approaching 110 again. But there's a direct correlation to a lot of things. Okay? The value of CAD might be falling. The value of Norway might be falling. Mexican peso could fall. Okay? Who imports oil? Well, Japan. Okay? Who else? The United States doesn't do it. Europe. Okay? Pound. Oh, well, I won't put pound in there because they have much of their own. So anyway, some people are hurt and some are helped. So I just want you to think about that. Who exports oil? Who imports oil? So this is nice that we go back into a normalization scenario. And strategically, this is quite nice, isn't it? From a strategy, from a technical analysis, strategy analysis type thing, it's a legitimate rollover. We don't really have a right shoulder yet, but we could. We don't have to. Okay? So typically what you do is you highlight the neckline. And by the way, you only highlight it. Some people think you buy here. Well, that only works for a head and shoulders pattern. What about a crown pattern? And you're like, what's a crown pattern? Well, if you get all these patterns mixed up, it's because somebody sold you a book or a training course on the million different patterns. There are not a million patterns. Okay? So this is a head and shoulders. Okay? This is a crown. Okay, and I'll add another one. This is a double top. And do you know what's most important out of all of these? They all have one thing in common. So there's only one thing I care about. Okay, there's a clear top, usually started by some sort of double top or something, but whatever. We'll just say there's a logical top. Okay. There's a breach. There's a retracement. And that predicts a new lower low. I don't care how you set it up. Left shoulder, double top. Okay. Whatever. 100% retracement or 138.2% retracement. Doesn't matter. It's not always lower low, but it's close, right? Lucas, like, for example, a head and shoulders pattern wouldn't make the lower low. It would come down to the neckline, go up to the lower high and down. But it is important. So in my book, 15, 20 years ago, one of the things I talk about is measuring this distance to this distance. And if it's a bullish trend, you would get like a 382, 50%, and a 618 Fibonacci retracement, right? So a fib trader would be measuring this, right? And then up. Everybody agree? So it's not necessarily you have to breach this and make a lower low, but this idea that it's gone 78% to 100%. So let's say an 80 to 100% retracement is not a retracement. It has become a reversal. So if you're down here, one of the things you would look for is something this way. Okay. But the lower low is a gift, right, Lucas? I mean, maybe you like let it do this and then you catch that lower low. Okay, fine. Either way. But, I just basically gave 3 or 4 different reversal patterns, one name. Okay. And that is sell the lower high. We call it a 1, 2, 3, or even a hammock. Alejandro says, hey, do you consider durational aspect? Well, yeah, that has to do with multi-time frame analysis, right? So, yeah. Okay. So, going back to this, okay, here's our area of concern. Here's our new roll reversal. Cool. Okay, if you're a bull, it looks like this. Now, if you're talking about duration in the sense of sensitivity to variables over periods of time, then no, different duration. Right? Some people, when they say duration, you think time. You're like, oh, it depends on the time. Well, sort of. Duration really says what happens if the Fed raises interest rates by 25 basis points? What happens to the value of your bond, let's say? Because the price would change. In fact, bonds would fall, right? So bond prices would fall if the Fed raises this up. Okay, but how much? Who loses the most? Who is impacted the most? Someone that owns a seasoned 3-month, 3-year, 10-year, or 30-year. Who's impacted the most by an increase of the Fed funds rate by 25 basis points? Dal says, how do I join the swing trading group? Join FX Bootcamp. And then at the bottom of the main page after you log in, there's a thing that says click here to upgrade your account. And it might even invite you to do it while you're signing up. It might just say, hey, thanks for signing up. Would you be interested in joining our live swing trading group? So, I mean, it's super easy. Okay. Raymond, I haven't had time to think about it. Okay. Come on, guys. Who's impacted the most? This is one measure of duration. You have duration risk. Or are you thinking that they're all impacted the same? Jimmy says short term. Come on, guys. Hello. How about this? Type in a question mark if you don't know. Well, let's say you have $1 million on the line. You have $1 million bond, right? There are 4 bonds. They're all $1 million. Okay, cool. So right, and you're locked in at, let's say, 1%. You earn 1% a year, or 1% annually over 3 months, 3 years, 10 years, or 30 years. And remember, you paid a price for it. You bought these things, okay? And there's a maturity date and all that kind of stuff. And there's a coupon, right? They're like, okay, you're going to earn 1% a year for 3 months. So at the end of 3 months, you get, 3/12 of your 1% and plus your face value back. So you have a face value, not future value, face value of 1M, okay, over this period of time. So the Fed raises interest rates, the price would fall because interest rates are now higher. A new bond pays 0.25% more than all the older bonds. So let's say a fresh cut bond now pays 1.25. And your bond says 1%. Remember, your bond doesn't change. Okay? You're locked in. So now, if you wanted to sell it, someone would have to have a choice. A new buyer would have a choice. They could go to the Treasury, or let's say their bond dealer, and buy a brand new bond that pays 1.25. Or they can go to the open market and buy your bond for 1. But what would you have to do to get them to buy your bond for 1% if they can buy a brand new one for 1.25? Well, obviously you would have to lower your price. And that's why prices fall. And of course you can do math and they can get to the point where there's really indifference and they're like, well, I can buy it from you or I can buy it from them. You adjust your price down and it'll at least equal exactly the same. But nonetheless, the price falls. It has to. It's just math. Okay? But the thing is, how much money would somebody lose? How much value is lost if interest rates go up by 25 basis points? Okay? How much have you lost in 3 months in absolute terms? Very little, because it just happens once, right? Because really in 3 months you're getting paid 1/3, right? Or 1/4 of 1% because of that 3 months, right? Because you only held it for 1/4. What about every year, 4 times a year, over 30 years, you're losing that same amount of money? Okay? It's 120 times more of a loss. Okay? Right? Because let's say 10% of a million is 100,000. 1% of a million is 10,000, right? So in this case, you lost $2,500. In this case, you lost $10,000 times 30 years. So it's $2,500 4 times a year. to a total of $10,000 a year, right? Wait, I'm throwing that off. That's how much income minus the change. Anyways, whatever. What I'm saying is you lose exponentially more money over the longer duration. There's duration risk, right? And of course, this person is out in 3 months. 3 months later, they raise another 25 basis points, and you're still locked in at 1%. And then 3 months later goes by and another 25. So these guys are losing. These guys are losing more. These guys are losing more. Okay? Plus, then Richard says in real terms, you're also getting crushed by inflation. Yeah. And of course, someone's inflation risk over 3 months is very little versus someone that has to project inflation for 30 years in advance. Okay? So that's duration risk. And so someone asked a question about duration, and really, well, it depends on what you mean, the sensitivity to that change. Because you might find one bond, okay, let's say the Fed raises 25 basis points, and maybe the value of a bond falls by what you would expect 25 basis points to impact it, maybe a 1-for-1. That would be like a beta, if you will, if you were talking about the sensitivity of a stock relative to the benchmark. Well, you could have also a duration for whatever reason. The Fed raises by 25 basis points and the price falls, but not by the math of 25 basis points. But let's say the math says, well, it actually dropped like the Fed rose interest rates by actually 33. So there might be extra duration risk because maybe it's an emerging market or something. And if the Fed rate is going up, maybe not only does it lower the price, but it hurts that currency, the emerging market, even more than just a slight beta, right? That change is even more hurtful and harmful to that other constituency. So you can look at like that would have, right, higher sensitivity to duration risk. Okay. Articulated Dream says, so why do people buy long-term bonds? Why do people have mortgages? It's just a bond. Okay? It's an asset-backed security. You get money, but then somebody gets a little piece of paper, okay? And it says and this is not like a typical bond. Like bonds have all kinds of flavors. So you might think of a bond where it has some sort of monetary value, $1 million. Okay. You're going to collect 1% interest. Okay. Per year. And then at a fixed date, so let's say in 30 years, so let's change this, 4%. Because that's actually where mortgages are. Okay, so you want to borrow $1 million. So that's $1 million bond, 4% a year interest rates. And at the end of 30 years, you get the $1 million back. Okay, that's a bond. The mortgage works differently. You borrow $1 million. That's the same. There's a 4% rate per year. Okay. And what is this? 30 years. I wrote that down. This should be 30 years. Okay. But instead, there's amortization. So 30 years. So they look the same, right? The difference is in the covenants that say, okay, you're going to get X number of dollars. And then at the end, there's a $1 million payoff. So you're going to collect a little bit month after month after month, but at the end of the whole thing, at the end of 30 years, there's a big payoff. That's a bond. Okay. A mortgage, okay, is more like, well, you're going to get X percentage of the whole kit and caboodle month after month. So at the end of 30 years, it will have dropped to zero. So there's no payoff at the end. Here, there's a ginormous payoff at the end. Okay, you get the face value back. Here, there's zero at the end, but you get bigger payments. You get your principal payment, 1/12, okay, plus 1/12 of 4% included. And then, of course, they even do it so you're paying more interest here and almost no interest there. And so they, and that's all part of these covenants. But at the end of the day, you are offering a bond. You are actually selling a bond on your house. If you do not fulfill the obligations on your mortgage, then you default on your mortgage. And because your mortgage is backed by the house, it's an asset-backed security, you back it by the house. So if you don't stop paying, they take the house. Dal says, how much does your swing trading group cost? Well, dude, we already told you. Go to fxbootcamp.com and you sign up, and then it'll tell you. But if you're not willing to do that level of work, we're not interested. Go figure it out. We'll see if you got what it takes. Go figure it out. Okay. Yeah. I know I'm sounding bitchy, but, we have a hardcore crew is all I'm saying. We have a hardcore crew. And yes, we support each other, but we're also, every single one of us is self-sufficient, independent, hardworking, that kind of stuff. Like, we'll do whatever it takes to figure it out, but we work together as a group. And obviously I provide resources, but like, if you can't figure out how much it costs, then it costs too much. Because the cost is you're going to sign up and then find out there's a whole bunch of work. Oh my God, it's work? Yeah. Yeah. So anyways, so you know already. If I threw that out to you right now, you're either like, I don't want to join, or you're like, I really want to join. Good. Okay. Thiago says, amazing time yesterday. Really? What was amazing? Tell me. I was so tired, man. I felt my whole forehead felt swollen. That's how tired I was. So I was sort of disappointed. And so if you thought it was good, then awesome. Okay. Okay. Now, Richard says, so you're talking about the rise of interest rates and the effects on bonds. Well, what is called duration. So it's different, though. It's right. Yeah, we're talking about the sensitivity to the change. Now, somebody said, so why do people buy bonds? So I'm trying to explain and answer that. So why do people buy 30-year bonds if they have a high sensitivity to interest rate changes? Well, why do you buy a house? Okay. Nurko says it was great. Awesome. You guys make me feel so good. Thank you. I'm telling you, I was really disappointed. And I was so tired, and I still couldn't sleep for hours because the markets were open and I had some things to do. And I'm like, I just want to lay down in a fetal position, cry for probably 20 minutes, and then throw a glass of wine down my throat and go to sleep. But, it's funny. So 2 hours after that session, I was actually on the set of The Walking Dead. And I could see zombies walking around. And I'm like, I'm so tired. Like, I don't even care about these zombies. There's zombies all over the place. I don't even care. And I think it was around 9 o'clock at night. It was lunchtime for all the for the crew and for the stars and all the extras. And all of a sudden, they had these giant cranes with spotlights, and they just lit the place up. It's 9 o'clock at night, and suddenly it was like noon, and everyone's out, and they're all getting to the trucks, and all the zombies are sitting around eating pastrami sandwiches, and and I'm like, I just want to go to bed. Should have been exciting. Should have been exciting. So anyways, I'm glad it was all right. Oh, and Tiago's like, yeah, Brian, yeah, it's good. I mean, I'm telling you, right? Cool crew, man. Okay, Sad says, is the sensitivity to interest rates the same as it is the inverse relationship to yield? Well, I would generally say yes. I mean, the mathematical question is different, but maybe the result is the same. That's why when interest rates go up, the price of bonds fall. And there's different ways I can explain it. In this way, I explained it like, what if you had to sell your bond that says right on it, if you buy this bond, you will earn 1% a year. And someone else can buy a brand new one and it says 1.25. So we know this instinctively from street smarts. If you're on the street and you're like, hey, buy my bond for 1.25, it'll cost you $1 million or $1,000, whatever it is. But there's a face value that says this thing's worth $1,000 and it'll pay you 1% a year. Now, a competitor shows up and he stands right next to you. And he's selling a bond for $1,000, the same as yours. But it says 1.25. Nobody would buy your bond. Nobody. Right? A 10-year-old understands that concept. Well, why would I buy your bond for $1,000 and get 1%? When I can buy this guy's bond for $1,000 and get 1.25. It doesn't even matter that the actual difference is like pennies. Who cares? Like, yours is worthless. It's worth less. It is worth less than that one. And then, of course, if you know math, you can just do some basic calculations and you can figure out exactly to the penny how much your bond is worth. But the thing is, it's worth less. The value of your bond would fall. If you want to sell your bond, you will have to lower the price to at least equal the other one. Okay? So, yeah, that's why prices fall. Okay? But now, there could be some other risks, though. Okay? Like, what if there was a chance at the end of the period, you might not get paid your big payoff again? Like, think about this, guys. Let's talk about this bond here. This bond. It's $1 million bond, pays 4% per year. It lasts 30 years. But you don't get paid much. You get paid a little bit every year. And then at the end of 30 years, you get your $1 million back. But what if you thought there was a small, but, what if you thought there was a 5% chance you wouldn't get your $1 million back? Would you lend the money? You're like, no, but maybe if they lower the price a little bit, I'll take the risk. What if you thought there was a 10% chance they might not pay you back at the end of 30 years? Well, they'll have to lower their price even more to convince you it's worth the risk. Because you're like, dude, well, it's still 90% chance they'll pay me. So if they lower their price, so let's say It's like this. What do you mean by lower your price? I will give you $900,000 and you'll pay me 4% a year on the million, and at the end of 30 years, you'll pay me $1 million back. And they might say, okay, we'll do that deal. 900K today, 1 million back in 30 years plus 4%. And you're like, okay, we'll do that. And you structured the deal that way. So now you're talking about, well, that's default risk. And now if this is a particular company that is more sensitive to interest rates. So think about corporations now. What if it's a corporate bond? Is Apple sensitive to US interest rates? No! They have $1 trillion in cash sitting in a bank. They don't care about interest rates. Now, what about a company like a shoe store that doesn't have $1 trillion in the bank, but constantly needs loans from banks to pay for inventory? So they borrow $1 million to buy some shoes. So now they probably want a 3-month loan, not a 30-year loan. So they go to the bank. They're like, lend us money for 3 months, or actually maybe let's say 6 months, so we can buy $1 million worth of shoes. The shoes are going to show up, 4 months from now, and they're right. And in 4 months, we will be selling the next season shoes. So in the summer, you order shoes for the winter. In the winter, you order beach sandals for the spring. Okay. So you're always ordering ahead. The shoes have to be manufactured, shipped, and delivered to you. Then you got to advertise that you have the shoes and all that kind of stuff. And then, in months 4 and 5, you sell the shoes you bought 4 months ago, right? And then you pay back the loan. So these guys now are constantly borrowing money. And so for let's say the winter, they borrow the money and it's 4.5 or 4%. And then they pay back the loan with the cash flow. And then they order for the next season, but interest rates went up. Okay. It impacts them. And they go through that same process and they pay it back. And then they order for the next season. And now it's, 5.25. Something really happened. And what's happening is now it's killing their profit margin because they're constantly borrowing at the current rate. Constant. Okay. And so there's some sensitivity there. Right? So the value of their stock would fall. Where Apple wouldn't be sensitive because they don't need to borrow money. They have more money than they need. They're actually lending money to people. So anyways, so there's all kinds of risk. Okay? And that's why sensitivity is different, and sensitivity to the change, but also change over time. And very often that is described as duration risk. Well, Raymond says when you have that much money. Well, that's the other sort of answer that I didn't want to give, but you could have, let's say, so you're rich and you have $1 million in bonds, high quality, we'll just say bonds, high quality bonds. They're not crappy bonds. They're not junk bonds and stuff. Okay. And you're earning a fixed income on that. Kind of like a house. Or like you own an apartment building that pays you money every month, right? The renters pay you money. There's a little profit at the end for you. And that's like a bond. Another reason you would borrow. Another reason you'd have a 30-year bond. But nonetheless, let's say you have this. But now the cool thing is you can leverage this as an asset. leverage. Okay. So you leverage that, and now you go to buy an apartment building, and you have a good deal on an apartment building, and it's in a good location. It doesn't need to be fixed up. It was just recently renovated, right? Everything seems to be good, and you buy it, but you go to the bank and you're like, I need $800,000 so I can buy this apartment building. And they're like, okay, we could lend it to you. It seems like a nice apartment building. It's a good location. The economy is doing well. We like it. It looks like a good asset. Now, what are you going to put as collateral? What assets do you have? If you default on us and not pay us back for the $800,000, how do we get the $800,000 back? Well, there's two things. The apartment building becomes an asset, but if they don't know you well and stuff, they're like, but still, how do we know you're a half decent manager and all that kind of stuff? Oh, well, I also have $1 million worth of bonds sitting in my bond account. Really? Yeah, and it provides a steady income, guaranteed steady income. And then, of course, the face value is $1 million. They're like, that sounds good to us. Great. So if you screw us on the $800K, if you stop paying your mortgage because, I don't know, who cares? They don't care. They're not managing the place. Hey, if the economy changes and people lose their job and you lose 20% of your tenants, bank doesn't care. F you, pay us. So they'll look at this buyer now that wants to buy the apartment building. He says, well, I really don't want to sell the apartment building. Even if I lose some tenants, it's still a good asset. I want to hold it over a long period of time. So if I have to tiptoe into my bonds and sell a couple of bonds, I can make sure, Mr. Banker, that the bank gets paid. And they're like, sounds great. Okay. What's up, Remy? Yeah, I'll actually be there next week. I'll be there for 3 or 4 days. So anyways, there's ways of looking at bonds, and why would you hold a bond? It's better than cash, and you can still leverage it. Okay. And of course, you can lend corporations money, and you can loan cities money, and you can loan states money. Yeah, thanks, Remy. I'm busy the whole time I'm there, so that's one thing. And yeah, I suppose we should. I don't know. I'm still a little bitter from from what happened. What was it, 10, 15 years ago? I'm sorry, man. I'm one of those guys, but I can get over it. So maybe, just not this time. I'm just not this. I know, like harboring grunges or whatever is just not a good way to live. So I'm just being honest, but yeah, I'm sure I can get over it. I don't know. Maybe I won't. I don't know. I'm laughing at myself, by the way. Right. I can sense it, like, I'm almost in my zen. I'm not quite old enough. Maybe when my hair's even grayer, maybe I'll just forgive and forget. So anyways, I'm laughing at myself. So yeah, maybe sometime soon. Yeah. Would the bank hold the bond as a security, right? Oh yeah, and you don't even remember, which totally makes sense. Totally makes sense. So anyways. Right. So would the bank hold the loan? No, but it's like a lien, right? Like you put it up as collateral and then they can legally go after it. But do you transfer? No. No. But if you stop paying, they can take it. Cool. Yeah. Did you Arsene, did you eat there? Did you just hang out at the bar? Did you go to a networking event upstairs, or is it frozen? Well, you can't. I don't know. Now you're getting technical. Can you leverage the same bond portfolio, 5 different mortgages? Maybe. I don't know. But yeah. That's interesting. Yeah, maybe. Could you? I don't know. I never took it that far. It's interesting though. Pledge it 5 times, and then default 5 different mortgages, and then there's only one. Right now, there's only 200,000 for everybody. And like, who gets what? I don't know. I don't know. When the rate goes up, the price goes down faster than the. No. Well, sometimes. So that's what I'm saying. On assets are not all the same. They may change differently. So let's say 10 different bonds will change differently to the same change in, let's say, rates. So rates go up a little bit. Each bond will change slightly. Why? Duration risk, default risk, counterparty risk, that kind of, right? Are they corporate bonds? Are they municipal bonds? Are they inflation protected bonds? Are they a structured bond type product? Or are they collateralized or not collateralized? Are they insured or not insured? So all these things will make each one a little more or less sensitive relative to everybody else. And so at some point, when you're a player in that space, you have to analyze all these things. And that's why bonds are very negotiable. Okay. Oh, okay. Yeah. Okay. Yeah. Yeah. So that's what I do too when I'm in New York is I say, hey, just meet me at the club. And I love hanging out there. It's really cool. And it works great for business. Man, being on 44th, West 44th, you're close to everything. And you just say, hey man, meet me at the club. Right? It's cool. Actually, that made me think of something. Hang on a second. All right, cool. I don't know if it makes raising capital easy, but it's impressive. It's definitely impressive. I like it because there was a time in my life where I thought I was excluded from such a thing. So now I love the fact that other people are excluded. I remember thinking, damn you guys in that private club, damn you Harvard assholes. And then finally I made it. I'm like, awesome, I'm a Harvard asshole. Yeah, it adds a little credibility. it's impressive when you walk in, you're like, oh my God, right? What'd you think of the big room? Yeah, it's like, oh, snap. You're like, oh, snap. Look at this freaking place. Holy smokes. New Yorkers are great, too, because they walk in and they're like, holy crap, this place is big. I'm like, yeah. Yeah. Sky Killer says, can you elaborate on that? I'm not sure on that. Define that, and I'll be happy to. Let's move on to, I don't know. So oil is stabilizing. Bitcoin is up. Okay, all of that is good risk on. We'll look at exotics. Okay, and we are now through 20. And we're at my target, so let's move this. I'm up equivalent to now more than 650 pips equivalent on Mexican peso. And we're right on the price right now. This is interesting. So one of the things we were talking about in the swing trading group last night is the psychological or even sort of mathematical risk you take now on this trade. Okay, so I've turned $3,000 into $6,500 right here. Probably a little more. Not quite. Yeah, I have $6,532. And I've locked up $3,000. So, okay, I have 200% profit. So here's the thing. I was asked, should I take profit? And I said, well, let's discuss it. Someone else said, well, you're killing that. You're getting awesome swap, right? So I've owned it for a month. And I have $218, or not quite a month, $218 in swap. So in a month, I'm earning close to $250. Huh. Interesting. $250. Okay, $250 times 12 months, $3,000. I'm earning. Okay, I earn 100% a year on this bond. I have a bond with them. I will get paid 100% per year on this bond. So it's like, that's the yield. Well, interest rate, we can call it yield. They're slightly different, but anyways, for 1 year. Okay, and at the end of 1 year, I will get my money back. Okay, so it's $250 per month. Okay, and I'm guaranteed my $3,000 back at the end. Okay, how do I guarantee that? How do I guarantee I get my $3,000 back? Because remember, I had to put up that cash. So that's my collateral. Yeah, my stop's at break even. So I could do nothing right now and earn $3,000 on my $3,000. Cool. Yeah, Richard's right. A lot of brokers won't pay you the $3,000 in interest. Your broker on this exact same trade, if you're using a different broker, you might lose $3,000. Do you understand it? Do you understand this process? Your shit broker might be charging you money and collecting money on the actual deal. They're double dipping. So in the course of 1 year, now maybe you don't hold a trade for a year, but think about it. They might have 10,000 clients. So they have a lot of clients when you add it up as an aggregate, right? The shit broker puts $3,000 in their pocket and then charges you another $3,000. You don't really care because you only see it, right? You only see a little bit of swap because you're only in it a day or two, and you don't really care because it's only a couple of bucks and you're like, whatever. But as the aggregate, nobody cares. Nobody even notices because they're not that smart. And so the broker's like, dude, we're going to charge these jerks $3,000, and then we're going to collect $3,000 from the central bank. We're going to double dip these a-holes, and we're going to get rich off of our clients. Bunch of losers. And that's how they feel about their clients. They're trying to find ways to take advantage of their clients. But I'm like, it's just stupid, right? Like, it's just bad business. It's bad karma. So anyways, instead, Traders Way, for example, pays you the $3,000 because that comes from the Bank of Mexico. It's not their money. Shoot, you earned it. So anyways, so you collect $3,000, and if your stop is at, it's $3,000 per year paid every single day, which breaks it down to let's say about $250 a month, but you get paid every day 1/31th of $250, right? So anyway, so you're getting paid every day, 1/365th of your $3,000. You jam your stop at break even. So now you face duration risk, or right, in the sense of you will always get paid. However, there's duration risk. What if you get stopped out before the end of the year? Then you're out of the deal and you stop getting paid. But you already collected the profit, but maybe you're only in it for 300 days or maybe 180 days or maybe 100 days and you get knocked out. Okay, fine. But you get your money, you get your 3,000 back plus whatever interest you collected. What else can change? The central bank could lower interest rates. So now you're only making $230 a month. And then they lower interest rates again and you're only making $220 a month. And they lower again. And now you're only earning $210 a month. But you're still getting paid. And that's different with a bond. A bond is fixed no matter what happens. Okay? Now, in this case, one of the reasons I made this investment is that they raised interest rates. So I went from 220 to 230 to 240 to 250. And I think this will continue going up over time. I will get little pay raises. The longer I hold this, I'll actually earn money, more and more money. I'll get pay raises, doing nothing, by the way, because I've analyzed the economy, the Mexican economy. I've analyzed the United States economy, and I've analyzed the monetary policy of the Bank of Mexico and the Federal Reserve. Cool. So all that's good. So I'm going to get pay raises. Okay. Now, here's the next issue. Technically, we talked about it yesterday, and we're actually hitting it now, and we are responding. That is a critical technical price. So here's the thing. If I get out right now and I take my pips, it's the equivalent of holding this short for 2 years. And isn't there a reasonable chance it does this? Well, that's 50% of my profits. So now I'm risking getting knocked out up here with the equivalent of 3 months worth of profit if you added my pips plus my swap, and I get knocked out way up here at near 21, I panic and I exit because it had this ginormous thing. I get out and I was only in it for, let's say, a solid month, but I'm only, right? But I've only collected maybe 3 months worth of interest plus pips, and it's an okay trade, but I'm dissatisfied. If I got out right now, it's worth 2 years of holding this short and breaking even. Now, do you see the conundrum? So now you're sweating bullets, the value of the pips versus the value of the swap. Remember, you can make money, but you cannot make time. So always a good investment is to convert your money into saving time. You will run out of time one day. So anything you can spend your money on that will save you time is well worth it. So you could look at this and say, I've been in this for 3 weeks and I'm being paid like I held it for 3 years. 3 weeks versus 3 years. Sorry, 3 weeks versus 2 years. Now that's a conundrum. I know, right? And that's what you'll face later on in life when you're building positions. This doesn't have to be one standard. This could be 10 little minis that added up to this over time. And that's what I'm trying to show you. I'm trying to show you here on this trade that it very quickly becomes decent money. If you can do enough fundamental analysis of macroeconomic conditions, you can put together trades that start to add up to real money. I don't want you to think, oh, well, Wayne, that's one standard lot and I only trade minis. There's no way I could do that, so it's all bullshit money. Well, one mini lot would still be $600. But the idea is what I'm trying to teach you is you take lots of little tiny ones. You got one there, 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 you got one there. Maybe you tried one in here, and you got 1, 2, 3, 4, 5, 6, 7, 8. So you have almost the same size position, and you did it over time, but because of your analysis, you were able to set the bigger move up, and you have each one of these trades are now at break even. And yeah, it might come up and take these two out. It's all right. And then you add 2 or 3 more on. And now you actually have a portfolio based on the Mexican peso. You could explain it fundamentally, both from the Fed point of view and the Bank of Mexico point of view, economic conditions, monetary policy, global money flow, the effect of geopolitical risk on these assets. And that you have a 3, 6, 9, and 12, 3, 6, and 12 month outlook for both these currencies based on that information I just covered. And then you say, and one of the things I love about it is I'm earning 100% return on an internal rate of return on this asset. Now, the next thing that we've talked about in the swing trading group is how to use this like a bond. Think about it, right? If you built a significant position on this, let's say you have a $10,000 account, okay? And over the course of time, you get $1,000 or $2,000 or $3,000. Remember your leverage, but let's say you get 20 or 25 or 30 or 40% of your account built up in this, all little individual trades, not a big bet, but you're thinking a year or two in advance. So you spend some time and you get to the point where you have a reasonable position built up on this. Then you switch gears and say, okay, on my $10,000 account, right? I got $3,000 worth of these trades set up, so you might have 30 little mini lots. Took you maybe a full year to do it. Doesn't matter. But now you have it. And they're all locked up at break even or better. You're earning the interest. Okay? And then you, with the rest of your capital now, you do trades that hedge this. So now you're like, okay, if the dollar gets strong, that's going to crush my peso position. So in that case, you're going to look to maybe sell euro dollar or something like that. And so you day trade euro dollar when euro dollar looks like it's set to fall. And then when euro dollar looks like it's set to rise, you don't do anything because you're already set on peso. So right now you're just buy and hold forever mentality. Click that swap. And your day trading now is all about hedging your position. Okay? And you're like, why would you do that? Well, think about it. Like, if you're earning 100% a year on 30% of your portfolio, then just on swap alone, you're basically guaranteeing yourself a 30% return per year. We're not even counting pips. You could be up after 2 years. You could be up hundreds of thousands of pips. Like your returns might be 100% a year with 30% of it guaranteed. And then the other 70%, you're actively hedging. Okay? You know what I'm talking about? What do you stink? Sky Killer says, hey, coach, should we expect profit taking? If you see it as support or resistance, then you should expect that. Yeah. If you're not sure it's support and resistance, then probably not. But that's the whole reason you don't look for support and resistance for the sake of doing the work. You're trying to identify entries and exits of other people or yourself. But you wouldn't buy it if you thought you were the only buyer, and you wouldn't sell it if you thought you were the only seller. Is there any way to? Yes. So you can get an account that is in line with Islamic finance. So you can get what's called an Islamic account where it doesn't pay or charge. And very often you'll earn differently. So it won't be called an interest rate, but you'll get, I don't know, something else. And in some cases, there's just none. Right. You don't earn or pay anything. Raymond says, just like my euro lira trade from 3 years ago. Right. That trade I was in for, I think it was about 10 months. I got knocked out at break even, and I made 1,000% internal rate of return. Articulated Dream says, don't they pump up the spreads instead? That would be a broker I would not want to work with. Okay. So the answer is no. An ethical manager of a foreign exchange brokerage business would probably say, no, we're not going to jack up the fees. If you're a client, we value you as a client, and we are excited to serve you. And if you have needs, cultural and religious needs that say you can't pay or earn swaps, oh, we can arrange for that. But they wouldn't like screw you over because it just like, it doesn't make sense. But I'm sure that happens on a regular basis. But I've never sat with a client or anybody that says, oh, well, they have an Islamic account, and then they roll their eyes. So, I'm getting screwed. No, I've never heard anyone complain that way. By the way, I took a class on Islamic finance, and my presentation at the end, every person had to do a presentation, and I did mine on Islamic bonds. And, there are ways of dealing with not being able to provide an interest rate, but yet bonds are very useful. Right? They're useful instruments. And as I was showing you, like, imagine living in a country where you couldn't get a mortgage. Is that a rich country or a poor country? Poor country. So obviously these instruments are important, but in a culture that doesn't allow interest payments, then there has to be a way to sort of structure the relationship. So there is some sort of compensation for the risk, but also recourse if the deal falls apart. But it couldn't be sort of the Western world way because of usury laws. Oh, right on, Sad. Well, in the book, Sad, I believe right at the beginning of the book, I said when I first started trading Forex, I sucked. Then I put in blood, sweat, and tears. And over time, I began to suck less and less. I think I even use those exact words. I know because I wrote my book. Now, I get accused a lot of that book being just like all the other Forex books. I'm like, really? I don't think you read my book. Of course, I haven't read anyone else's book either, so I'm not really sure. But that book is pretty frank. Most people try to impress people on how smart and good they are. And so that's how I opened up my book, where I just said I sucked. Now, another interesting thing is the first time I spoke at a Forex conference, it was the very first Forex Traders Expo. I was a keynote speaker. And I was really excited because it was the first time I spoke in public in regards to Forex. I'd done a lot of public speaking doing all my other businesses over the years. But they're like, hey, so this is, would you like to be a keynote speaker? Hell yeah. And then working with them, they're like, hey, do you want a booth? Do you want a table? I'm like, I don't want a booth. I don't want a table. I just want to go and speak, and I want to meet people. And they're like, well, you can also, put stuff in a bag, in the conference bag. And I thought, because the internet was even young back then. So people didn't watch videos on the internet. YouTube hadn't been invented for another 5 or 6 or 7 years. So anyway, so I'm at this conference and I'm like, you know what? Yeah, I'll pay money. So it was like $5,000 or something, right? I'm like, I'll pay $5,000 to put something in the bag. Remember, I don't make money on any of these things, right? So I'll fly to Vegas. I'll do the presentation. Cost me thousands of dollars just to show up to do a 1-hour presentation. Then I'm like, okay, yeah, I'll put something in the bag, pay them $5,000. What I did is I made DVDs. So I paid some company, then again, thousands of dollars to make thousands of DVDs. And on the DVDs was me doing video presentations of how I trade Forex. Cool, right? So what would a normal person do? They would show all these awesome trades, on, this is me trading and I'm so great. If you just did this, you'd make money. And then if you did this other thing, look at this chart. Look how I made money. And if you just bought here and up there, right? And beautiful. So I spent all of these, so let's say I'm in it for $10,000 just for the DVD. And people took it home because they couldn't watch it there, put it into their DVD player, turned it on, and in the very first trade, I take a loss. I'm like, so you do this, and do this, buy it. And then, it didn't work out. I lost money. And just like, whoa, dude, seriously? I'm like, yeah, I got to be brutally honest. That's how I would set it up, but boom, dead. That one didn't work, so let's go on to the next one. That one was mediocre. Well, let's go on to the next one. Right? Ted says, was Sammy around then? I don't think so. No. In the early days, the guys I remember is me, Rob Booker, Ashraf Ladi, the guy in CNBC now who used to be with Gain Capital, not Brian Dolan, that was his boss. What was that guy's name? It's just slipping my mind. Ada says, I want one of those DVDs. They're somewhere. I don't think I have another one, but I might have one. What's that guy's name? Nice guy. What the heck was that guy's name? Todd Gordon. There you go. Thank you. Yeah, so it was like Todd, Ashraf, me, Booker. And then there were like people that just weren't that good. Those guys are good. And there was one time I'll never forget. It was just great. It was Todd, Ashraf, and me on a panel and with some other dude. And between Todd, Ashraf, and I, we were all alpha males. we were just all over, not each other, but just like vocal. And the other guy barely even get to speak. And I'll never forget it where like Todd's talking at the time, and he's chief FX market strategist for Gain Capital, right? Forex.com. And he's talking and he's like, yeah, look, if you can't plan your trades in advance, they're not worth taking. And he says, in fact, what I do is I plan all my trades and then I enter all my trades by phone. He's like, I actually call my orders in. And if you can't call your orders in, then it's not a real trade plan. And then I take over. I'm like, okay, Todd works for a broker. And they have $1 million invested onto their online trading platform, which was new at that time. And he still calls his orders in. I'm a regular guy. I don't work for a broker. I don't work for anybody. I'm just a regular Joe that trades Forex all day and all night. And I actually click buttons to enter my trades, right? And I'm like, so yes, I agree with Todd where you have to plan them, but let's look at, ways to maybe manage that, anyways. And so we're on top of each other. And then Ashraf would jump in and kind of jab at me and at Todd. And meanwhile, there's a fourth guy on the panel not able to say anything because we're just... So anyways, they were all good though. Like I always remember Todd, he would always have a white business shirt on and a nice pen, and he would take notes when somebody asked a question from the audience. And he was very professional, but he looked more like an accountant at the time. But now I know he does a lot of YouTube stuff and he's still on TV, and he's an Elliott Wave guy. It's cool. I mean, he was good. And Ashraf is smart. I like his fundamentals, and like they're good guys, but I only kind of ran into them at those types of events, but I know they could hold their own, right? They can hold their own anyways. Yeah. So, but everybody else, there were a lot of scumbags and scam artists at those events. And so I ended up stopped doing them. Once I had, kids, you have to remember too, I spent, I think about $300,000 a year going to those conferences, and it was just for fun. And no, once I had little itty bitties running around, I'm like, I don't really have the time. I don't really have the time. And, I'm just like, I don't want to do it anymore. And I just stopped. But the guy that wrote the book, his pitch was he went to Japan and learned about, Japanese candlestick patterns, and he had all the books translated from Japanese to English, and now he can teach you about all 7,000 patterns, and each book is $500 each, and then his training course is this, that, and the other thing. And it got so scummy that they wouldn't let him speak anymore at the conferences. And so he showed up one time with just a visitor's badge, like not an exhibitor, not a speaker. He just showed up, and I'm at the FX Bootcamp booth, and there's like 50 boot campers, and we're all standing around talking. And for some reason, he's not reading the room very well, and he comes right up to me, and he's like, "Hey, I saw you speak. Yeah, good. And then he's like, "Hey, if we work together, we can do this and we can do that." And he's pitching me like on this relationship, but he's talking a little bit scummy in front of like everybody, right? And so anyways, and I'm like, "Why would you do that?" And he's like, "Well, we can make a lot of money together." And I looked at him and I said, "Well, I already have a lot of money." And he's like, "What?" I'm like, "Why would I do all that for money?" I'm like, "I'm not really interested, but thanks." And it was just funny. And he just looked at me like, "You mean you don't do this for money?" So he was baffled. So it's kind of cool. Those old memories are just kind of cool. Like, he was just baffled. What do you mean? All right, let's go through some dollar pairs, huh? What's up with Rob? I don't know. I think he's retired. Okay, just stuck here. We've been stuck here all week. That's all I can say. My trade is, I think, right here. That's that. Well, Richard, a lot of these guys used to work together. So in the very early Forex days, like I think Ashraf and Todd, and I can't remember the third guy. There was some other. They used to work together at was it Schlossberg maybe? They worked at Drexler or something. And they were on the Forex desk, and like somehow they used to know each other. I'd have to look it up. I think they all used to know each other from the most early days, and then Forex became retail, and they all jumped to brokers. So there is some sort of connection with the old guys, right? With the old boys. And then everyone else just showed up after. And yeah, whatever. Everybody after is everybody after. So anyways, boom, 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 boom. But it shows you that you can build a career, right? Like Joseph Trezevani, I met him for the first time in Spain, and he was telling a story, like I said earlier, how he was in Bermuda, right? As a Forex trader, he was in Bermuda, and there were only 4 or 5 other Forex traders. So he just, after work would hang out at a bar, and you're like, "Hey, oh, you're a Forex trader." And all of a sudden, there was just a crew of like these 5 guys all knew each other, and they were the only Forex traders on an island filled with stock traders, options traders, futures traders, all these traders. They're all doing these trading for hedge funds and stuff. And there was like 5 guys that did Forex, and they would hang out, and they got to know each other, and they were like traders. But do you know what he was doing before that? He was a New York City taxi driver. And I'm like, no way, Joseph, you're kidding me. And he's like, yeah, for whatever reason, I don't remember the story. I just remember that he did that for a while and, a reasonable amount of time, not like 10 years, but, and I'm like, you know what? That's an amazing story. That you can go from New York City taxi driver to suddenly you're living in Bermuda and you're one of, you're 20% of the Forex world trading Forex, right? I'm like, that's awesome. Then he hooked up with, what was it? FX Solutions, right? And he was doing well there. And I had dinner with him one time in New York City and we went to this fancy place and he was just doing killer and he just bought some loft somewhere. And I'm like, dude, you're awesome, man. What a success story. Now he does a lot of work with FX Street. And he knows the stuff too. He's really good fundamentally. Yes, he's earned my respect for sure. Yeah, I was thinking about it. Yeah. I must have had dinner with him 3 times. I think twice in New York. Yeah. Knows the stuff for sure. Faux show. All right. USD Kitty Cat Oscar Mike. I never traded this one all week. I was out of position. I was afraid the whole time, and I never did it. Sorry. Reasoning or rationale, if you will. We open the week here, and this is my sell zone. And I wanted to sell this. The intent was to sell it. And I guess I could have got here, here, and here, and here. I just never did it. I never got the opportunity that I wanted. So that's that. So I look at it and I go, Kiwi Dollar. Okay. This has gone up and down, up and down, up and down, up and down. Guess just, this is just basic technical analysis now. Mark that and watch the 21 as a dynamic level of support. Okay. Be careful of that. Okay. Bulls are going to see it differently. Aussie, very, very elevated versus the dollar. And yeah. Depends on what happens in the rest of the market. I think like that would be interesting. Take a look at some of the pound pairs. Uh-oh. Pound has had a rough night. Okay, so we're still in this process of making lower highs and lower lows. Articulated Dream says, "Hey, any book recommendations on commodities?" I've never read any books, so I don't know of any books. I don't. Right. So. is it Alexander Elder? Is that the guy's name? That says, you said trading for a living? Is that who that is? Yeah, cool. Interesting that you bring that up. When I was first looking at Forex, I was still busy, full-time job doing my VC stuff, but I started playing pretty significantly. And my dad and I would sometimes talk in the middle of the day. He'd call me at work or I'd call him from work, and we'd talk about Forex. I'm like, I'm up 300 pips on euro dollar, right? But I didn't know anything about trading. And so it was just, silliness, but I was learning about it. And so my dad bought me that book, but I never read it. I think I still have it somewhere, like on the to-do list. So that's why I know it, but I never actually read it. Interesting, right? So you recommend it? Well, maybe I'll read it this weekend. Who knows? Anyways. Pound Swissy again. Uh-oh. Okay. And if you've had young children in the last 20 years, you probably recognize what I'm doing. Uh-oh. So anyways, there I am. Got really close, huh? Yeah, so we'll see if I can survive that. Let's take a look more specifically how close I got. Okay, so far so good. Maybe I'll survive. Probably not. I don't want to write another book. I've done enough. I don't think maybe after I retire or something. There's a lot. I'd rather do research and then release that. But I remember standing on a podium and showing a picture of my book on Amazon. It was the #1 bestseller for the foreign exchange, right? Best-selling foreign exchange book. And it wasn't available yet. And so that's good enough. It's good enough for the girls I go with. So why write another one? I'd have to do research. It wouldn't be about trading. I wouldn't want to write another trading book. It would be about finance, economics, the business of trading, but I don't think it'd be trading. I think the way it would go down is I'd start my own fund. I'd retire, because to me that's retirement. I'd have you guys trade for me, and I'll just fly around in jets all day and mentor you. Be your mentor. I'll fly in a couple of times a month, see what's going on, check your performance, kick a few people in the ass, give a couple awards out, have a few dinners, make sure everything's golden, and then get back on my jet. Okay? So you can do a rooftop party. Okay? You take the worst performers, like, oh, it's award time. Hey, Right? Hey, so-and-so, come on up. Yeah. And they come up and they're like, really? You're giving me a word? And I'm like, push them off the roof. Nope. You suck. Get the hell out. And then and then the next guy, I'm like, hey, Peter, come on up. And you're like, I don't know if I want to come up. I don't want that award. Peter comes up. I'm like, oh, look at this. I bought you a Cadillac. Good job, Peter. Yeah, actually, it's funny. I don't want a jet. But anyways. Well, the thing is, as you guys know, trading is a tough gig. So you have to, everyone has to perform, and there's no downtime. Yeah, I'll push you to be the best trader, or I'll push you out the window. Right? I'll push you to be the best trader. I'll shove you out the window if you're not. Yeah, I don't want a jet. That's so silly. Oh man. Yeah, well, Articulated Dreams, I have nothing to do with that book. You have to remember, I didn't even have a manuscript, and they paid me money up front to write one. So I wrote a manuscript. Then they're like, we love it. We want to buy it. So I sold it to them. That's how it works. So I sold them my book, and so they paid me some money up front, and then I earn a royalty, and it's hardly anything. Okay, I think I earned $5 a book or something like that. It's really small. So it's their book, not mine. And they set prices. How do they come up with that price? I don't know. They're the largest publisher in the world. I don't know. I don't know these things. I don't know anything about that. Okay. So pound Swissy surviving. Pound Singapore dollar surviving. Cool. And we're at key turning points at some of these other things. You can see pound Kiwi double bottomed at exactly the price it should. And pound Aussie is trying to do the same at exactly the right price that it should. So that's nice. It's great. It's working out. So good job, Great British Pound. Stabilization. Let's get rid of that. That was from last night. Stabilization in yen pairs. Just moving along. So I think I'll just leave it at that. It was kind of a nice hangout today. I know it was sort of all over the place. Lots of talking and stories and stuff. Dude, I'm exhausted. It's Friday morning. I'm just exhausted, but I'm having fun. And I'm living on adrenaline, and I'm trying to drink more water. More water, less adrenaline would be great. But I'm just around, man. I'm just around. So I got to get through today alive. I got some other work to do off the charts, all that kind of stuff. But I hope everything is wonderful. I hope you have a wonderful weekend. If you could leave a comment and a like on the video, that would be great. We need help telling YouTube this is quality content. And, that's it. So I will see you Sunday afternoon if you're in my live trading group. Okay. Is Off the Charts coming back? Well, right now, I'm spending a lot of time with my live groups. And then outside of that, I got to do my job. I got to do all the other things outside my normal job. I got to raise my family, my kids, and all that kind of stuff, and provide. And right now, I'm only sleeping 4 or 5 hours a day. So am I going to do Off the Charts with Wayne McDonald? I don't know. I just don't know. Right. It's just like, I just don't know. But, yeah, well, maybe. How about that? Just maybe. Cool. So anyways, peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend. See you Sunday if you're on my day trading group. Cheers. That just happened.